Welcome to Economic Mobility as a Tool for a Sustainable Future, a virtual event presented by the Georgia Tech Library. I'm Charlie Bennett, a librarian and liaison to the Schools of Public Policy and Economics here at Georgia Tech. Our guests today are Dr. Raphael Bostic, the President of the Federal Reserve Bank of Atlanta, and Dr. Kaye Husbands Fealing, the Dean of the Ivan Allen College of Liberal Arts at Georgia Tech. Dr. Bostic is an economist and a professor of public policy who took office as the president and CEO of the Federal Reserve Bank of Atlanta in 2017 after teaching at the University of Southern California and working at the U.S. Department of Housing and Urban Development and the Federal Reserve Board of Governors. Dr. Husbands Fealing is an economist and a professor of public affairs who taught at Williams College, the University of Minnesota, and here at Georgia Tech, where she served as chair of the School of Public Policy and is now the Dean of the Ivan Allen College of Liberal Arts, which has a special place in my heart. President Bostic will speak to us first, and then he and Dean Husbands Fealing will have a conversation before we start taking questions from the audience. President Bostic, I give you the floor.
Well, thank you, Charlie, and hello, everyone. It's really a tremendous pleasure to be here. Having been a professor for, 16 or 17 years, it's always nice to be back in a college setting, even if it's virtual. So really pleased to be here and actually very, very excited to be talking about sustainability and economic mobility. These are very, very important issues for us at the Federal Reserve. And it's something that I've been working on, an issue that I've been working on through much of my career. So really happy to be here and really looking forward to the discussion that we're going to have over the next hour or so. Let me start by saying just a little bit about economic mobility and just to set the tone of what it is we're talking about. So when I think about economic mobility, really what I think about is the notion that someone who is born in a certain station has the ability through hard work and effort and leveraging the resources around them to wind up in a different economic station. When I was growing up, there was a fictional character known as Horatio Alger, who really embodied this, and his story embodied the rags to riches narrative that is so common when we think about the American lore and in the American psyche. And so that's the sort of thing that we are looking at. Now, unfortunately, economic mobility is not and has not been a reality for many, many Americans. For too many Americans, to my mind. And this is one of the reasons why our bank has lifted up increasing economic mobility and resilience as a strategic priority. It's something we collectively are taking on because we understand that if we do better in terms of economic mobility, it will actually improve our ability at the Federal Reserve to fulfill our maximum employment mandate. Now, let me step back a bit and explain that and unpack it so that you have a much better sense of what I mean by that. So we're the Federal Reserve, the U.S. Central Bank, and the Congress charged us with two mandates. We have a dual mandate. One is stable prices, so to make sure that the trajectory of prices happens in a stable way so that it's very predictable, so that businesses and families and young people can make investments and have some confidence that they know what prices are going to be 5, 7, or 10 years down the road. The second mandate is maximum employment. It's trying to get as many people employed as possible. Now, one of the challenges that we have when we think about maximum employment is what benchmark would you use for that? Like, how do you think about what maximum actually is? Now, when I think about it, there's a short run way to think about it, which is what's the maximum number of people who could be fully employed today? And that's going to be a number, and that'll be a function of what skills you have today, what kind of jobs are available, and how businesses are growing. But there's another way to think about this, which is, I may have a certain set of skills today, but if I go to school or if I do an internship or do something, I might get a totally different set of skills that opens up a new set of opportunities for me. And if we can do that collectively and broadly through the population, then the ultimate maximum employment that we achieve can be far, far greater than what we have today. And for us, in terms of the Federal Reserve, I think there's real value in us trying to advocate for everyone taking steps so that we can achieve that broader, longer run notion of maximum employment. Now, to do this, of course, we're going to have to think about what targeted populations are we going to be thinking about most heavily. And to consider that, we really have to get into our heads the question of, well, who is the economy not working for? Who is not fully engaged in terms of offering their time and their effort and their innovations? Because that's the gap. That's where there's this extra potential. And when you look at the data, there are a couple of groups that certainly become clear. Women, for example, we know that there are pay differentials. Women get paid less than men do for the same work, and there have been a lot of studies on that. And then another thing that is less well recognized is that women are not equally represented in all occupations, and they are disproportionately located and they disproportionately work in occupations that pay lower wages. Minorities, ethnic minorities, African Americans, Latinos, they are another group for whom collectively the economy is not working as well as it could. The unemployment gap, the gap in unemployment rates between African American males and white males has been large. African Americans have an unemployment rate about double that of whites historically, and that's been true for decades. They also have the same sort of sorting issues in terms of occupations. And so there are real challenges there. And then this goes beyond just people. If you look at geographies, we know that there are some geographies that are not as well connected and well engaged in the American economy. In the 6th District, which is the Southeast where I have jurisdiction, I look at across the map and I see a lot of rural places, a lot of smaller towns that used to have very robust economies that are less robust now. And so we have to think about trying to fill the gap in all of those places. Now, one of the things that I want to emphasize in the context of this conversation is that if we do better in terms of having the economy work for all people, if we get people who are in those gap spaces to be more fully connected and to be more fully realized, they will wind up having higher wages. They'll wind up ultimately getting higher incomes and hopefully even savings far beyond what they have today. And once you're in that position and you're more resilient, then you have the ability to have a lot more economic mobility. Because if we get people from whatever their trajectory is today into better income, higher income and wages, that then allows them to move to that other station, that alternative station that I talked about earlier. That is the embodiment of economic mobility. Now, we talk about this, and I like the title of today's session, which is Economic Mobility as a Tool for a Sustainable Future. So let me say a few words about why I think economic mobility actually does lead to increased sustainability. The first dimension, I think I'm going to point to 3 points here. The first is that when I think of sustainability, one way I think about it is in terms of resilience. You know, when we think about the U.S. economy and all the things that have happened around climate change, our communities will be more sustainable if we are better prepared to deal with the large hurricanes that have hit the Gulf Coast on a regular basis over the last several years. We will weather those better. We will fall less far, and we will rebound much quicker. We will be more sustainable as an economy. And I think that analogy translates very nicely to where people are. And when we think about people, if people have more income, if they have more savings and wealth, then when a bad thing happens, they're going to be able to weather that better. They will be more resilient. And that means that we won't have to use as many resources to try to support them when they are down and when times are hard. A second reason why I think economic mobility is really important for sustainability is that when economic mobility prevails, it really increases the likelihood that people will persistently strive to be great. People will persistently strive to participate in the economy because they will have a belief that effort will translate into positive things. And as long as you have more and more people that are willing to engage, you're going to get more and more economic activity. You're going to get more investment. You're going to get more robust and energetic pursuit of happiness. And ultimately, I think you wind up with a much more vibrant community where people are engaging with each other, trying to get the most out of every moment. And that really gets to the third issue around economic mobility and why I think that it translates into a more sustainable future. One of the things that I've seen in my career is that when you bring diverse groups of people together, ideas get challenged in very different ways. And ultimately, if ideas survive those sorts of challenges, they're better ideas. They're better notions and strategies for moving forward because they've been just battle tested in a harder way. And the ideas and concepts and strategies that survive those are going to be the ones that have the most likelihood of success. So if we can have economic mobility that lives on and exists in all of our communities, that means that we will hear voices and get input from a broader set of people than we do today. All of the ideas that we get will be challenged in different and more rigorous ways, so that the ones that survive and the ones that rise up will be the ones that provide us with the most value add, the most economic surplus, and we will wind up with a far more competitive economy and a far more competitive marketplace where people are going to succeed, and we will all be better off for that. Now, let me just close, because I really do I'm looking forward to the conversation with Dean Husbands Fealing, with one last thought, which is that when I think about economic mobility, it immediately takes me to a tagline that we have here at the Federal Reserve Bank of Atlanta, and that is an economy that works for everyone. There's something that is very dear to my heart, that what we are trying to do at the Federal Reserve is establish a foundation so that every American, regardless of their background and regardless of what they are aspiring to, has a foundation that allows them to get that. In many ways, a successful realization of economic mobility in every community is an embodiment of an economy that works for everyone. And so I think there's something we should definitely try to pursue. And let me stop there and let's move to the next portion of today's program.
Raphael, thank you for your opening comments. As always, succinct, informative, and I'm looking forward to this part of our program. I have a few questions for you, and I want to start off the first one by citing a couple of papers and studies that were done a few years back. And one of the outcomes was this: 92% of children born in 1940 earned more than their parents, whereas only half born in 1984 did. So there's this decline in the rate of upward mobility that we see in those data. So at the Atlanta Fed, you've made it really an important character of the Fed right now to promote economic mobility and resilience as one of your core strategies. That is not a traditional focus, as you said earlier. So I'd love to hear you dig into why did you choose to make mobility and resilience a top priority?
Well, thank you for that, Dean Husbands Fealing. I'm going to call you Kay, if that's all right.
Yeah, please call me Kay, of course.
All right, that's good. You know, it's a very interesting journey that we've been on at our bank. When I first got here, we were still kind of post-Great Recession and thinking hard about what our next step should be. And so I got together with my senior leadership team, and we did, over the course of 6 or 7 months, a series of retreats where we said, what should our strategic priorities be? And collectively, our leadership decided that economic mobility and resilience and the pursuit of increasing it should be one, because there was a broad recognition that it was closely tied to our mandate of maximum employment. I would say we have two other priorities. One is to become more agile as an organization. On some level, that has been incredibly challenging for us as a bureaucratic central bank. People don't think of central banks as sort of agile organizations. We've made a lot of progress and strides on that, and I've been really proud of our bank in that. And then the third priority is to promote safer innovation and payments. As I think you know, and many of you may know, Atlanta is a hub for payments. I think the statistic is 2/3 of all payment transactions in the U.S. touch a business that's located in Atlanta. So we have developed some internal expertise, and we are trying as much as we can to make sure that as that sector innovates, it innovates in ways that are safe, so that our payment system remains resilient. On this front, I would also say we are talking about innovation for financial inclusion as well, because innovation sometimes can be expand access to opportunity, but sometimes it can close it off for people if you don't have, say, access to broadband, or if you are a cash-based society. A lot of the innovation in payments has to do, it requires you to have a credit card or a debit card. So we're trying to make sure that as innovation happens, it happens in an inclusive way, so it doesn't matter sort of what your approach to payments is. You can still benefit from those services. It's another way actually to get to economic mobility by making sure that everyone has access to the best products and services that are available. But it's been a journey. And the thing I think we've discovered as we've leaned in more to economic mobility and resilience is that there are so many ways that our bank operates that are relevant for this, whether it be bank supervision and helping banks think hard about how do they access populations that maybe they haven't gotten as much penetration to and gotten services to, whether it be payments, as I just talked about, in terms of access to the most powerful products and services that are available, or whether it be just monetary policy, some of our basic bread and butter type of work to think about, well, should our framework, how do we think about the execution of monetary policy in the context of promoting economic development and more sustainable mobility. On that last point, let me also say, the Fed doesn't have answers to everything. Like, we don't have the authority to just do all the things you might need to do to increase and improve economic mobility and resilience. But despite that, I actually think it's quite important that if we see barriers to that, barriers that are making it harder for us to achieve our mandate, we should be talking about that and letting people know that these are areas where strategic investments can create robust change that allows our economy to evolve in ways that advance all of our interests.
Fantastic. So there outcomes that are beneficial for communities, for individuals, but also for the banking system, also for general economy, for competitiveness. You've pulled many threads here, and the reason why focusing on economic mobility and resilience is part of your core function and one of the main strategies that you're focusing on right now as you are leading the Fed here in Atlanta. That's terrific. I actually want to touch on something you just said, and here's a question about what you can do and can't do regarding mobility and lifting up those who are in the margins of the economy. We all understand that the Federal Reserve wields considerable influence. Still, it is legally constrained in what it can do in areas that most directly affect economic mobility and resilience, especially as it concerns lower and middle income communities. Can you briefly talk about what the Fed can do and, importantly, what it can't do? What are those differences here in pursuit of fostering economic mobility and lifting up those on the economy's fringe?
Sure. So this is such an important issue, and I will just say that it's really important that people understand we are the central bank, and our primary vehicle for policy is really governed by that reality. So we execute monetary policy, which is sort of a broad-based policy that affects the entire economy pretty much in the same way. So it's a very blunt type of an instrument. A lot of times when people think about and speak to solutions around economic mobility and resilience, what they're really talking about are targeted investments, targeted funds or funds being channeled to very specific communities or very specific types of infrastructure to try to make change and to try to improve how the economy functions in those spaces. Those aren't tools that we have the authority to do. The Congress can do that, state governments can do that, governors can do that, but the central bank really can't do that. So in the context of those issues, what can we do? I think there are 4 other things that we do that can really be helpful. One is that we can convene and we can bring together the parties who might have the ideas and the authority to do those things to try to create an environment where they can work together to find solutions. And what we try to do in a lot of our convenings is have different kinds of conversations than what we've seen before. An example of this right now is a Racism in the Economy webinar series that we've been running for this, basically for a year now, where we basically bring together academics, practitioners, other thought leaders to talk about barriers that have been established because of the existence of racism, and more importantly, what solutions might look like. And many of those solutions aren't things that we can do, but it is important that we facilitate those conversations. So convening is one of the things that we can do. A second thing we do is research. So I have a band of researchers here at this Reserve Bank, and across the Reserve Banks, we all have researchers that work in these areas. And we try to really put a spotlight on the ways that the markets work and the way the economy works and the ways that it doesn't. And once we can try to get more and deeper understanding of those things, that can be important. I would also say on this, we try to facilitate research as well. So I've been talking in many contexts over the last year and a half, trying to get academics at institutions like Georgia Tech to take on these issues and add them to their research agenda, and that's important. A third thing that we do is advise. Since we've become more widely recognized as being interested in these issues, city governments, state governments, legislators from across the country and in Washington, D.C. have reached out to us to say, what are you seeing? These are the challenges we have. Are there people who might be able to help us work through them? Sometimes the answer is we have that expertise in-house. Sometimes the answer is we know a group of people that you might want to work with who can really help walk you through that. So that advice is something that we do. And then the last thing I would point to here is we promote what works. So, we have the luxury of being part of a broad system, the Federal Reserve System. There are 12 reserve banks. There's the Board of Governors in D.C. That allows us to have relationships with a lot of folks and a lot of communities who are trying things. And we can work with them to figure out what works and then lift those ideas up. One hard reality is that in many cities and towns across the country, they don't have extra staff to do lit reviews and to figure out and do their own evaluations of programs and those sorts of things. And if we leave it to them, they're never going to find, it's going to be very difficult for them to find the things that work. So if there are ways that we can help with that, for example, we have a Center for Workforce and Employment Opportunity. So my folks here know I'm terrible with acronyms. I'm just going to say that. They call it QUIO, and I can't do that. Anyway, and one of the things that we do through that center is identify workforce programs across the country that seem to have made a difference and make those available and known to local governments so that they can figure out whether those things will work for them. So there are lots of other ways that we can weigh in without necessarily having to do grants to a particular program or to a particular community.
This is a fantastic answer, and I will come back to the way to engage students in a minute. But first, I wanted to talk about the Partnership for Inclusive Innovation. That's an organization you've been very active in. Our former President Peterson has been, Deborah Lamb here at Georgia Tech, and Lieutenant Governor Duncan. How do you see that partnership facilitating some of the things that you just mentioned?
Well, I'm very glad you brought this up. This is something that I've been very excited to be a part of. I was glad that the Lieutenant Governor asked me to participate in the initial work on this, where we really tried to think about if Georgia is going to be an innovation hub for the eastern half of the United States, like what are the things that we need to do? And the Lieutenant Governor was very clear that he thought that the important word there was Georgia and not Atlanta, and that he thought it was very important that it just was more than this, reached beyond just the usual suspects who would have access to venture capital and the like. And so when I think about how that partnership is moving forward, what I see is creating new networks, creating new communities, bringing in different kind of voices around what good ideas are, and then letting them run. And one thing I've learned in my time in this role is that there are lots of smart people all over the place, and too often there are smart people who don't have an opportunity to let those ideas that they have blossom into things. And this partnership is really creating that opportunity across the state. And I'm very excited. I think that what we're going to see is cities and towns are going to have a lot of infrastructure embedded in them that allows people who live there to do things that they couldn't do. We'll get deeper broadband in a lot of our smaller communities to make them competitive for businesses. And we're going to see a lot of small businesses in things like agriculture be able to use technology to leverage the productivity, to leverage them to increase productivity and to be more competitive in the marketplace. The more that we do of those things, the better off Georgia's going to be, for sure. The better off those communities will be, and ultimately, I think the better off our country will be.
So I do want to get to the question about students and the how students can be involved in what we're talking about right now, and how this economic mobility will benefit the students that are listening to this today. Many Georgia Tech students will move into jobs and positions of influence, just as you said. What advice might you give them to incorporate the value of economic mobility into their day-to-day life? What might that look like from a practical standpoint for a computer programmer or an engineer or someone in the liberal arts?
So, it's a really good question. Let me start by saying this. I think small actions can make a big difference. I think everyone should have in their mind that I, as computer engineer, software developer, I can make a difference, and that difference can happen one person at a time. So the first thing I would say is intentionality. Have this on your list of things that you care about, that you want to make sure that as you go through your career, you want to help improve, because that intentionality may mean that as you're thinking about recruiting people, you will notice that you're only recruiting people from certain communities or with certain backgrounds, and to think that maybe there are some good ideas that could come from other places, and how do we tap into those other places? When I think about networks, who's in your network, and are there ways to expand your network to include people from communities that where economic mobility and resilience have often been lacking? At our bank, one of the things that we've done is we've created an internship program for high school students from more poorly performing high schools, because we had a view that they were not getting access to our networks and didn't really understand the opportunities that the Federal Reserve could afford them. That's actually a fairly easy program to run. It doesn't cost millions of dollars to do this, but the personal connections can really change trajectories in really robust ways. And then a third thing I would say is think about how you measure it. One of the things that I've seen over the last several months is that a lot of businesses aren't aware of how their policies and practices are relating to economic mobility and resilience. And so thinking about that, measuring it, understanding it, then can translate into building a strategy to deal with that. I've been working with the Metro Atlanta Chamber of Commerce, and they have a racial equity initiative that's going on right now. I would encourage people to go look at that, because what you'll see there is a series of playbooks for businesses that if you want to think about improving supplier diversity, or if you want to think about changing the employment trajectory of people of particular backgrounds, we have playbooks up there that should just be downloaded and used to try to make that progress, because small steps can make big differences. And I think it's really important that we do all that we can to make it as easy as possible for people to start doing things, because it's action that's ultimately going to make the difference.
So I have a question along the lines of what you just mentioned, and I want to transition and ask a question about the Sustainable Development Goals. Goal number 1 is no poverty. In your work with the Federal Reserve, Is this something you've been thinking about? And have you been thinking of poverty eradication as a sustainability issue? And just now, you just said also you want to see how what you're doing here in Georgia and in the 6th District generally, how that can be a model for us in the nation.
You know, it's very interesting, Kay. This is a question I had a feeling what you would ask. And so I went back to my team and I said, so, you know, you have these UN sustainability goals, and we have actually used them as a guide for our sustainability program here at the bank. So we have, our bank is LEED Platinum. We were the first LEED Platinum facility in the Federal Reserve system. And so our guys really scoured over the UN sustainability goals. We did not actually use goal 1 as a motivation of poverty eradication, but we did use a couple others that I just wanted to point out. So goal 8 is to advance decent work and economic growth. And the ultimate goal there is to make sure that we have an economy that works for everyone. And they almost use exactly that language, which was kind of ironic. Goal 10 is about reducing inequalities, which also feeds very much into this notion of disparities and disparate access to economic mobility. Goal 11 is sustainable cities and communities. And so a lot of the stuff we do to advise and to promote what works kind of advances all of these issues. Goal 12 is to have responsible consumption and production. And so how we think about reusing resources and the like is really essential. And then goal 16 is peace, justice, and strong institutions. And part of what we're trying to do is really strengthen our institutions to make sure that they are equipped to do the things that we need them to do. I'm actually going to go back to my team and ask why we didn't have goal 1 on there, given that it does kind of fit into all of this stuff. But I think the broader point is that we do need to be making sure that we are mindful of where precariousness is, because precariousness is a risk to sustainability, and it's a risk to resilience. And so if we can effectively reduce that kind of precariousness, and poverty is as one indicator of that, you know, I think we wind up in a more sustainable and more resilient posture.
Thank you. And I would like to say, too, that here at Georgia Tech, President Cabrera has leaned heavily into the SDGs and the faculty here in terms of research, in terms of developing curriculum. So that is actually something that is close to our hearts here at Georgia Tech. I have another question, though, and that is about the current times that we're in. I can't avoid asking this question. What we're going through the last 18 months or more with the new coronavirus, and how that has affected economic mobility, how that has affected inequality, all of the things that you laid out so beautifully for us at the beginning of this conversation. Tell us a little bit about what impact has happened that you're seeing in the region, and some of the ways in which you think we can go about working through with some viable solutions, especially looking towards sustainability.
So one of the realities of the pandemic has been that it has put stresses on all the parts of our society that were on some level the weakest. It found all the people who were had health issues and morbidities and comorbidities, and it hit them hard. It hit the segments of our small business community that had the least savings and the least wealth set aside to weather a storm. It hit our families and the jobs of families who had the lowest incomes, and as a consequence, the lowest wealth. You know, usually in a recession, what happens is that most of the job loss happens in the middle of the wage distribution. It's those middle class and middle income jobs that get hit the worst. In this pandemic, it was the lower end of the wage distribution that got hit the worst, and disproportionately. That's very unusual. But what it means is that the stress that we were under collectively was just much greater and much different than what we've seen historically. Now, in terms of the response to help make this work, I think the U.S. has done actually quite a remarkable job. We at the Federal Reserve moved very quickly to make sure that there were no doubts about our willingness to support the economy through monetary policy and providing liquidity to many markets. But very importantly, the Congress passed waves of relief packages that were really designed to target businesses and families who were going to be most exposed to the risks. You think about the Paycheck Protection Program to help support small businesses and make sure they can keep hiring, keep their existing staff on staff. And I've talked to many businesses who say, we wouldn't be here today if there wasn't a PPP. You think about the expanded unemployment insurance, which helped people who had lost jobs because of the pandemic to still be able to buy food and to pay rent and to do all those sorts of things. And we haven't seen things like like an eviction crisis that many people were expecting to see very early on in the pandemic. Now, we're not out of the woods, and I don't want to suggest that we are totally out of the woods, but I do think that the policies that were put in place have been very effective in creating a bridge for people and businesses to try to survive from the beginning of the pandemic through to the end of it. And one of the challenges has been that this thing has gone on a whole lot longer than anyone has expected. You know, businesses that we surveyed originally thought this was going to be a 3 to 5 month issue. And now, as you noted, we're at 18 months and we still got a ways to go. That means that all this bridge has got to be harder to sustain. And we're going to have to think about how we do that moving forward. But I think that's been helpful. Now, from where we are right today, I think the thing that I worry about the most is that as we move further and further away from the depths of the pandemic-driven recession, that we start to just think, oh, we're good, and we can declare victory and move on. And the thing that I think we all need to keep in mind is that the communities that were hit the hardest, the businesses that were hit the hardest, they had the least to weather this. So their fall was going to be deeper and their recovery is going to be slower. So as we move forward, it's important that we stay mindful of that and keep tabs on how things are evolving in those communities to make sure that their already precarious situation doesn't permanently leave them just that much further behind everybody else, because that will make achieving economic mobility just that much harder. And so we're going to have to stay mindful on that.
Actually, I want to turn to a question about monetary policy, and I'm noting that in the chat, also in the question and answer chat on the side, and I invite everyone to put their questions there if you have a question for President Bostic. Raphael, monetary policy, we have to turn back to that and one more time. Monetary policy can seem arcane to lay people. And most of the time we talk about, support for citizens that really is more on the fiscal side, and monetary policy sometimes seems a little obscure. But the Fed's policymaking group, the FOMC, the Federal Open Market Committee, of which you're a member, made important changes to the strategic framework last year. Can you tell us a bit about those changes and why they matter for ordinary people, particularly those who have often struggled on the fringes of the labor market?
Sure, happy to talk about this. We've been doing monetary policy for a long time, and we have lots of history and experience about how markets work and how they respond to our policies. But what we saw coming out of the Great Recession were responses to our policies and dynamics in the market that kind of didn't fit with the long time history. So we decided we needed to look at this a little more carefully and closely. So we started a series called Fed Listens, where we went around the country and we hosted a series of seminars and conference sessions where we asked people, what's your experience with inflation? What's your experience with employment growth? How do you think about our policies and how they touch people? And what we heard was a very clear message that the Fed, in many people's views, has preemptively halted growth by raising interest rates at the hint or at the risk that inflation might get high without actually seeing any of that inflation even starting to occur. And that by moving preemptively, what it was doing, it was making it difficult, if not impossible, for those who were typically the last ones to get onto an economic recovery to actually get in and stay in. And one thing we saw over the last in the years after the Great Recession is that we could let the economy, when the economy ran hotter than we thought in our models, it was really prudent in those historical models. We didn't see that inflation. We didn't see the thing that we were afraid of, which suggested that, well, maybe we could just run things a little hotter for longer and do that without having the loss or the risk of inflation rise. Because typically when inflation starts to get out of hand, the economy overheats, that leads to a recession. And we're really trying to avoid having to do drastic policy changes to address that. But what we found is that that wasn't really called into the question. And so in the new framework, which we released last summer, we basically said, we're going to let employment run hot until we see inflation. We're going to let the data drive it and not just sort of the risk that a model suggests we should have. And the hope there is that it will allow for more jobs to be created and more jobs to be created in a sustainable way, so that the last ones that get in, those ones that typically get in at the tail end, are getting into jobs that are just more stable and more robust and aren't going to go away because a recession comes 3 months after they just get into the job. And that's the thing we're trying to eliminate. Now, an interesting thing is that in today's world with the pandemic, it's created a whole different inflation dynamic, which has made things a little more complicated. But I think the basic principle is still going to hold out. We're going to stay lower for longer with the hope of facilitating the creation of many more jobs and many more sustainable jobs than we have seen in previous expansions.
So I just want to drop in real quick and say we should probably open up the conversation for questions from the audience. If you're watching now and if you're watching live now and you would like to go, I believe, to the right side of your screen, you should find a Q&A spot. You can drop your questions in. And Dean Husbands Feeling, I think you see those questions now.
Yeah.
All right. You should feel free to start pulling from there and see if you can really test President Bostic with some of our audience's questions.
Well, I have two questions that I'm going to read together because they're about digital currencies. So I know this is a topic that you enjoy discussing and sometimes debating. Would you provide more insight on central bank digital currencies and when we anticipate the U.S. launch of the CBDCs? And then the second question was that what your outlook on monetary policy, specifically in reference to COVID-19, digital currencies or cryptocurrencies, and their intersection to economic mobility for a sustainable future? So pull the thread there on the cryptocurrencies and digital currencies. Thank you.
Well, you are definitely testing me on this one because the answer to those kind of take me in two different directions. In terms of a central bank digital currency, this is the first thing I would say is this is a much more complicated issue than I think many people appreciate. And I will just say for us in the Federal Reserve, we've got tons of people working on this and a number of different work streams just to try to resolve all the questions that arise in the context of a central bank digital currency. Let me just talk about a couple of the issues that are that I think we have to have clear answers for. One of the arguments in favor of a central bank digital currency is that it makes it easier for us and the federal government to get funds in the hands of particular households. They don't actually have to have necessarily a bank account. They will have an account with the government that we can just transfer funds, say stimulus payments or anything, so that people have direct access to that. And the central bank in that model is the facilitator, the service provider in that. So if we go that route, and I do understand that there are benefits to that, That is a fundamental change in how the central bank and how our central bank relates and interacts with the general public. Nobody on this call right now has an account with the central bank. Like all of our relationships are with banking institutions and financial institutions to facilitate their business, and then they have relationships and accounts with consumers. Once you do that, like that's a massive undertaking. That would be a massive undertaking for us just in terms of building systems that can facilitate and manage that. But moreover, I think it has real deep implications for the regulatory structure. Because once we have an account that is directly tied to us, if people use that money, we will have the ability to know how that money is used. And to me, I think that raises a lot of questions about privacy and rules of the road around what the government should know, can know, where there's liability, all those questions. I think they're all quite significant. Another question I have, or issue we have to understand or think deeply about, is does this change the relationship between banking institutions and the broader economy and consumers? Like, what are the implications for the evolution of the banking sector if we have a central bank that is potentially such a significant player in the marketplace? And a follow-on to that is, and so then what is the implication for the execution of monetary policy? Because right now, the vehicle that we have is through the relationship we have with banking institutions. And if that relationship with the broader market changes, then the transmission of monetary policy, that's what we call sort of the mechanism by which it works, we call that transmission of monetary policy, that then is called into question. So those are just a couple of issues. For me as a central banker doing monetary policy, that last one may be the biggest one. But that one, you said that monetary policy is arcane earlier. That arcane issue, I think, is really large implications for how we think about central currency. In terms of the crypto space, that is a rapidly evolving space. And what I'll say is there are a number of challenges when we think about economic mobility and resilience. One of them that I think is very significant is just how dramatically the valuation of that currency, those currencies change over time. And I don't actually like to call them currencies because they don't have the properties of currency, which is the values stay relatively stable. They stay in a very narrow band. Many of the cryptocurrencies that I've heard about, they have wild swings. And if you're looking at families that don't have a lot of savings, that means that you're exposed to a lot of risk because your savings could be worth $50 today and $14 tomorrow, depending on the swing in valuation. And I'm not sure every family can afford that kind of volatility in their asset base. It's one of the reasons why I've seen a lot of people gravitating toward something called the stable coin, which is a digital currency or cryptocurrency that is tied to the value of a particular asset, whether it be a dollar or gold bar or whatever. And so the valuation stays stable, right? And that's why they call it a stable coin. How that gets propagated and introduced and spread, I think that's an interesting question. And it's something that I will continue to watch, and my colleagues here at the Federal Reserve will as well.
And I believe also, Raphael, you've been watching how this has evolved and is evolving in other countries as well, right? And so that's part of what you're benchmarking against.
That's exactly right. And this is a global issue. And I think every central bank is looking at this. And I think it's important to be mindful that the economic and social context in which these decisions are being made really matters. In China, the government has a different relationship with the public and with the control of markets and information than I think we could get away with here. Given that, the things that other countries are going to be able to do may be quite different than what will be possible here in the U.S. And I just think it's important that everybody recognize that context matters a lot, will matter a lot as we think about future designs of payments and currency.
Thank you. I'm going to transition to a different topic. A couple questions again I'm going to bundle. What is the Fed's role in making housing more affordable for all? especially for those in low-income and middle-income communities. And a similar question, or a question I want to bundle here, could you provide more insight regarding gentrification in Black communities as a barrier to economic mobility?
So how much time do you have on these things? Like, these are big questions and big issues. On the gentrification issue, let me start with that one. One of the challenges that we all face is that economic forces are powerful, and they will drive certain dynamics that are going to be very difficult to blunt directly. If you have communities that are located in places that are desirable, and an economy is growing robustly, people are going to notice that. And that's going to put upward pressure on prices and the demand for use of that space. I think a couple ways to sort of deal with that. One is to try to preserve some of those lands. So I was on a panel last week in Cleveland where we talked a lot about land trusts, where you have a nonprofit or that's sometimes facilitated by a local government that actually controls some of the land and communities that we care about and tries to help. Another approach is to sort of minimize the burden of ownership of properties in targeted neighborhoods. You may be familiar with Proposition 13 in California. That was passed because property taxes were going up so high that the existing homeowners couldn't pay them and instead were effectively forced to sell their homes. And so we need to be really studying to see, are there things in place? Are there costs to home ownership in a lot of our closer in minority neighborhoods that are causing our homeowners to want to sell or need to sell, to feel the need to sell? Then a third thing that is also somewhat a challenge is that for many of the homeowners that we're thinking about here, the sums that they are being offered to sell are far greater than what many of them had ever contemplated they could ever get from their house. And we also need to think about managing expectations and thinking about, well, who else needs to be in the auction to buy these homes, because ownership allows you to shape what happens. And so I think I know there are a number of funds that are being compiled right now to try to get into those auctions and to buy and establish philosophies and principles about what happens to those homes and who lives in those homes. Then a fourth thing I would say is that we also need to think about creating as neighborhoods change, opportunities for existing residents, particularly renters, to stay, and making sure that there's a mix of housing. And consider policies such as first choice or first option renters that may be tied to the location of where they are living before, just to try to manage the mix in certain communities and help those who have been in these communities for a long time. And when some of these neighborhoods were struggling, and they were pillars of these communities, to actually be able to benefit from the good things that happen because of that perseverance. I think that's really important. Now, in terms of affordable housing, all of you know that almost all of this is determined at local levels in terms of zoning and planning commissions and approvals that are given by local jurisdictions to facilitate the development of housing and its density. So a lot of the on-the-ground stuff that's going to matter is going to be proposal by proposal, is going to be in general plans for cities and for neighborhoods. And this is something where people in Georgia Tech can have a significant role to play in shaping expectations and creating city visions and working with communities to try to lay out affordability as a priority that is willing to be protected and preserved. I think that's really important. For us at the Fed, we actually do a fair amount talking about the dynamics of these markets so that people understand that there are supply challenges that are driving affordability issues in some places. In my previous life, I worked at HUD, and one of the things we found was that Whereas we thought that issues around the quality of housing were kind of behind us, there's still a lot of substandard housing out there. And how we manage that can be another way to keep people in neighborhoods and to reduce the stress and burden on affordability. Then the last thing, because I know I've gotten long on this answer, but the last thing I would say is affordability is a ratio, right? It's housing costs relative to income. So I think we should also be thinking about ways to get people to have higher incomes, because that's another way that you can reduce their precariousness and reduce the challenge that they face. And that brings us full circle to the economic mobility conversation, that we need to make sure that people are getting the full value of their skills and talents and are able to really fully participate in our economy.
Raphael, I fully expected a digest on the answer to that question. And you can look at your articles as well, even recent articles in 2020, 2021 on this topic, but going way back for a couple of decades as well in the work that you've done. So thank you for that answer on housing and mobility. There's another question here that I want to ask, and I know that we're running low on time in terms of, but this one question is about the New York Stock Exchange, so I felt that I had to ask it. The Fed has attempted to provide economic mobility and stability via multiple rounds of quantitative easing. Given recent developments in the market, do you still believe this is the way to go? For example, the president of the New York Stock Exchange said, I guess here it's quoted, stocks do not reflect actual value. And then they are also referencing Janet Yellen saying that we may be running out of dollars soon. Anyway, that's the question, basically looking at economic mobility and stability regarding with respect to the markets.
So let me just start by saying the level of the New York Stock Exchange is not one of my mandate metrics, right? My mandate is maximum employment and stability of the price level. So I start there very squarely. And when I think about quantitative easing, one of the motivations for that was to make sure markets continued to function so that we still had jobs and people could still be employed and have wages and earnings. In an environment when interest rates, when our primary interest rate policy tool was basically at zero, right? So we needed to find an alternative approach to try to provide some stimulus to try to help the economy grow. So I actually think of it sort of much more linked to the fundamentals of employment and inflation. And much of what we've done has really tried to preserve that. Now, I go back the first round of quantitative easing when the Fed jumped out and said we're going to provide liquidity to these markets. There was tremendous fear in the economy, and people were very much afraid that it was all going to come tumbling down, and that would have been the loss of tremendous value, and more importantly, loss of a ton of jobs. And because of the policies, the fear kind of got calmed down. People calmed down. We were able to preserve employment and ultimately start to turn the dial and move from loss to gain. Now, it took a long time, but I do think that it's important that when people think of our policies and look at them, they stay focused on the mandate, because that's what I do. And I know my colleagues well enough that we take that mandate very seriously.
So there's another question here that I feel compelled to read, and then one more question that I have to get back to the question about economic growth. This question comes from somebody that wrote to us in the chat. Can you provide any insight toward the near daily all-time high reverse repo transactions and what it says about counterparty risk in the system?
All right, so this is super arcane relative to even relative to general monetary policy. Let's just suffice it to say that what we try to do in executing our policies and sort of ensuring that markets stay liquid and can operate is we create some opportunities for banking institutions and other market participants to take some of their liquidity and park it somewhere. And these are, and we manage that through so the repo market and the reverse repo market. And I take the activities in the repo market as a signal of whether we have enough liquidity or whether we don't. And right now, I think the signals are pretty strong that liquidity is not our problem. It's not the problem in this marketplace. And so I take that on board, and then that gets me to think about sort of how should we approach those policies that we have in place to manage that liquidity, such as quantitative easing, such as buying these assets. And looking at the signals from the reverse repo market is really giving me a sense that we might not need to be providing as much liquidity into these markets as we have been. And maybe the market or the economy is telling us that those policies can be dialed down. And I'm in favor of starting that dial down as soon as possible, and look forward to a time when we don't need those, where the economy can stand on its own and can continue to grow robustly without needing such a strong push from the Federal Reserve.
Thank you. I have one more question to ask, and this is really to get your understanding right now of the state of work and economic growth in the Southeast United States, but also the future of work in this region. And what is your understanding of where we are, where we're going, especially regarding the SDG number 8, as you mentioned earlier, decent work and economic growth as a goal?
Yeah, so this is a more expansive question. Well, the answer should be more expansive to this question. Let me just suffice it to say, the Southeast has been a part of the country where there's been a tale of two cities almost. It's almost been like we've had multiple economies. You have places like Atlanta and Nashville where we've seen really explosive growth in frontier sectors and frontier industries. In Georgia Tech, you guys are churning out tech companies by the dozens that are accessing capital sources and really producing high value add products and high wages and revenues. But you don't have to travel very far. I mentioned earlier sort of the geographic divide in terms of places where the economy isn't working for people. And those are places that are losing jobs, they're losing population, and their horizon is somewhat cloudy. And when you talk to people from those places, they're nervous and they're worried. And so those are the realities. There's a lot of stuff that's really working well in the district, but there are a bunch of places where it's not working nearly as well. And that's the backdrop for sort of the second part of your question, which is sort of where are we going? What we do know is that there are a number of types of jobs that are going to be plentiful. And we also know that a number of those jobs are paying good wages where people will not be as precarious. Now, some of those jobs exist today. And if you go to our website, we have a tool called the Opportunity Occupations Monitor, which at a county by county level identifies jobs that are plentiful, that don't require 4 to 6 years of schooling, and that pay a good wage. And those exist today, and we project that those will continue to be around for many years to come. Those would be things like welders and carpenters. There's going to be, and plumbers, there's going to be a need for them. But then we also know, I talk to a lot of businesses and they tell me, automation can't be denied. There are just going to be a number of things that are automated. But the other thing they tell me is that in many of these instances, though automation does eliminate some jobs, it also creates others. And I was at a plant in Tennessee. It was a tire plant. And it is so automated that humans do not touch any rubber in the plant. And they're churning out tires and tires. But there were people everywhere. They were just doing different things. And the challenge that we have right now is that the skills you need to do the new jobs are really different than the skills you needed to do the old jobs that are going away. And we've got to figure out how you match that up so that the people who lose their jobs can get the skills to fill and be competitive for those new jobs. I think that's our biggest workforce challenge in the years to come.
Perfect. Thank you so much, Raphael. It was a real pleasure having this discussion with you, and I turn it back to Charles.
Yeah, I don't want to cut you all off, but we're coming to the end of our time. It's been a fascinating conversation, and I'm delighted you could be with us today. And I'm sorry for the all-campus outage in the middle of the event. We've never had that before, so this is a very special event. I'd like to invite Catherine Mancy, the public programming librarian, to come back on and bring this to a close. And I want to thank you both again for being here.
Thank you for joining us, everyone. And I'd like to thank our presenters today, President Raphael Bostic, Dean Kaye Husbands Fealing, and Librarian Charlie Bennett for a wonderful program. Today's program is part of the Georgia Tech Library's Public Programming Initiative to reveal tools and ideas for a sustainable future. If you'd like to know more about our workshops and our classes, you can visit the Georgia Tech Library website. I'd also like to tell you about a way that you can stay in touch with the Federal Reserve Bank of Atlanta. You can text FRBA to 33777 to receive their weekly digest. And finally, I'd like to thank you all for joining us for such a wonderful conversation, and we hope you'll join us again in the future. Have a wonderful day.